Good morning and welcome to our first In the Room webinar of 2021. My name is Steve Backhouse and I'll be your host today. And today I'm chained to Warren Buhai from STANLIB Asset Management. Welcome, Warren.
Thank you very much. Thanks for having me.
Yeah. Before we kick off, we always run through a couple of house rules. So today is very much like all In the Rooms, an interactive webinar. So it's Warren and I having a chat. I'll ask him a bunch of questions, get some insights from him in terms of how he sees the world, his investment process. And please, I encourage anyone in the audience to also ask questions via the Q&A tab. And then we'll pick those up and I'll hopefully ask Warren some of those questions. The format of today, what we do is I'll chat to Warren, as I said, for about 20-25 minutes. Then we'll open the floor kind of to questions. Get into your questions, and then we'll carry on. We'll close the webinar at 10:30 sharp. So an hour webinar. And we look forward to it. Cpd Points. So we're still unfortunately waiting for the Cpd Points to be approved for the webinar. But if you attend the whole webinar, well, I think about 90% of the webinar, you will get your Cpd point. If you can't attend the whole webinar, you can then watch the recording, and then you have to do a short assessment for your Cpd point. I think that's all in terms of the house rules. Cool. Otherwise, we can get into it. So Warren, maybe as a start, pretty good idea. Maybe tell the audience a little bit about yourself.
Sure. Been in the industry just over 20 years. Started at STANLIB in 2005, and before that I was in corporate finance at Standard Bank. Various roles for me. I've been in the resource analyst, fund manager in resource funds, multi-asset funds, now absolute return funds. I joined the absolute return team about 3 years ago, moving from multi-asset. Some people would have seen me before, management of the balanced and balanced cautious funds at STANLIB. And that's what I've enjoyed about my career, different roles and different parts of the value chain within asset management. And importantly, the evolution of how my role has taken time, I think has been good for me and kept me interested. You know, this role is difficult to avoid the monotony, I guess, of any job. And for me, the changing roles over time has certainly kept me interested. And it's a fascinating world we're in, which is a great time to be in the industry.
Yeah, no, it certainly is. I think a lot's changed over the last kind of 18 months or so, and then you also spent some time in the States. I mean, it was quite a short stint, if I remember correctly.
Yeah, just under 2 years. 2007, had an opportunity to go work for a global wealth manager there. Fascinating time. Also ran a hedge fund, and interesting time to be in America through the global financial crisis. Fascinating to see how cities and country can go from boom to bust so quickly, how various things impact that, how the policy response impacts that. It was an interesting time to be there, and also interesting for me to see a different culture. What I did realize is how South African I am. I came running back in 2009, actually just before the market bottomed post the GFC, which was by a good chance that I came back at that time. I found out that I love South Africa. And people forget that the quality of life that we have here, and I was in one of the best places in the world in Florida, in America, and I still wanted to come back, and I'm very happy that I did. I'm very happy here since then.
We were talking before we kind of went on air that I recently watched for a second time the movie The Big Short, which obviously you lived through that process through that time, and it was a movie I recommend to anyone to kind of watch again. A fantastic movie. Okay, so we'll get into now our conversation. So, as you said, you recently, I mean, probably 2 years ago, 18 months ago, you joined the Absolute Return franchise. And I mean, and I know I've heard that the potential of franchise is going through a name change to multi-strat. Yep. Can you talk us through kind of why you're changing the name and what's behind that?
Yeah. So for us, we think it's a natural evolution, moving from Absolute Return, which is the name of the franchise currently, It's going to move towards more what we call multi-strategy. The name change should come through, as you say, in the next few days. And it's a kind of an evolution of thinking for us. In absolute return funds, obviously, there's quite a core focus on capital protection, which we don't think you find in traditional balanced funds. But we think going forward from now, returns are going to be much harder to come by given the world that we're going into, and we can discuss that as we go on. But we think risk management is as important to investment management. We think in the past, investment management has been more focused on just capturing beta of asset classes and not really worrying too much about risk management. It's kind of 10% of the time spent, and that's halved off to some quants person in the background. We think risk management's got to be right on top of the investment management process, as important as investment management, as I say. And with that, we think you need a lot more quant skills. And we've buffed up the team now from 4 people a couple of years ago. We're now 9 people. Much more diverse spread of qualifications in the background, from engineering to astrophysics to actuarial science. A lot of data science in our team now, a lot of data science backgrounds. And we think that, as I say, that's going to be important going forward for the risk management. And bringing different strategies together, not just focusing on traditional asset classes, looking at non-traditional asset classes as well, and how you put these strategies together in getting the best outcome for clients, putting the client at the center of that, not just letting the client be, taking the outcome of whatever balanced funds do. We think it's important putting the client at the center, looking at the objectives of the client and kind of going down the path with them together. Importantly, controlling that risk is going to be critical going forward.
So you talk about risk management. I mean, as you said, there's always been an element of risk management, and we hope so, in portfolio management.
Yeah.
But I mean, and you said, but now this is something more important because of kind of the world we're going into. Can you try and almost like dumb down the risk management piece for us? So like, what do you mean by kind of the risk management piece and kind of and where it's going? Where do you think it's going?
Sure. So I'll give you an example. It's kind of, if you take the example of the big drivers of asset classes, often currency and interest rates, it's about where's the currency risk in that portfolio. People only think currency risk is when you take money offshore. But if you think about the South African JSE, almost 3/4 of it now are multinational companies. So each of those companies have currency risk. They all operate in different countries. They manufacture in different countries. They sell in different countries. So each of those companies, when you take it down to the micro level of the portfolio, has some currency risk. Now, we think it's important to know exactly what that currency risk is across the whole portfolio and manage for that currency risk. The same thing with interest rate risk. You'll have different fixed income products in South Africa offshore. It's important to know what the interest rate risk is across the portfolio and holistically manage that, potentially with derivative overlays, if that's what you think is appropriate, but important to know exactly where the risks are, both on a factor basis. Factors, we mean things like currency and interest rates, and styles even. So you think about the equities that we've got invested. Has it got a growth bias? Has it got a value bias? And again, controlling for that risk. And the reason why I say that's important, we do think we're going into a potentially different environment for what we've seen for many decades now. If you think about going back to the 70s, where the last time we had high inflation, from 1981 is where interest rates peaked. And since then, now it's 40 years, we've had interest rates declining over time. The only time we can see in history, going back now over 100 years or when the Fed's been in existence, is the only time you see interest rates this low at the 0 level bound is through the Great Depression and into the Second World War. And what you saw coming out of that period, and unfortunately it's the only period we really have that's comparative to where we are now. It's interesting because what's happening at the same time now is not just monetary policy keeping interest rates at the lower level bound. What you also have now is fiscal policy coming to the party at the same time. We haven't had that in the world. They've generally acted counter-cyclically, which means when the one's been stimulating, the other one's been doing the opposite. Finally now, this is what COVID actually brought about. COVID was the catalyst to bring monetary and fiscal policy much closer together. And what that means is the potential for inflation to come about is much stronger than it's been for 40 years now. You think we've been in a 40-year period since 1981 when interest rates peaked in America of declining what we call disinflation. So not necessarily deflation outside of Japan, but disinflation. And why did we have inflation coming down? Things like globalization, finding the cheap labor where you could around the world, technological advancements, bring costs down, movement of people, movement of factories. All these things have added to costs coming down over time. We know that goods inflation on things we buy like TVs and monitors have just been coming down for 40 years. The problem is now when you flood the world with money, and that's what the fiscal policy is doing, is what does that do to the inflation outlook? Does it change? We see deglobalization now at the moment. while there's massive technological change still to come, is it going to change the labor dynamic in the world? What is going to happen with wages? We haven't seen wage inflation for many decades. For example, in the US, they're talking about the first federal increase in the minimum wage that there's been since 2009. They haven't had an increase in that for 12 years now. So all these things are starting to look like potentially there's a change in the inflation outlook. And if I just go back to that historical example coming out after the Second World War, you saw inflation go much higher and you saw big inflation up and down cycles. You also saw the macroeconomic cycle get much shorter. And that's usually what happens when you go off a zero level interest rate base and start increasing rates, even gradually over time, which is what happened then. You potentially have much shorter cycles. Remember what we've seen in the last few decades is some of the longest cycles we saw in history. The average of the last 4 cycles, I'm talking about macroeconomic growth cycles, have been about 102 months. So just under 10 years, which is quite a long time. Previous to that, and certainly in this period in the 1930s and 40s, the periods were less than 4 years on average, much shorter cycles. And we think we're potentially going into that environment where you have potentially much shorter macroeconomic cycles, recessions more often, but potentially shallower recessions. What you saw in that period, you didn't have deep recessions, they were shallower, and the equity market corrections, interestingly, were also shallower. They weren't as deep as the ones we've seen, the dot-com bubble blowing up, the GFC, and even what we saw in last March were all 30% or more. We think you might have shallower market corrections, but just a lot more often than you've seen historically.
I mean, if I'm hearing you right as well, you're saying is it, and again, trying to pull it back, is it that geez, actually the world is a lot more complex now from an investment point of view than it has been maybe in the last kind of 40 years.
100%.
And what you're doing is actually you're moving kind of your investment strategy and bolstering your team to make sure that you get this right from an investment point of view.
Exactly right.
Yeah.
What we've seen for the decades, just to close this off, with declining interest rates, you had that huge tailwind for risk assets. When the cost of money continuously comes down for 4 decades, you can imagine it provides a massive tailwind for assets. Going forward now, you won't necessarily have that. Even if interest rates go sideways for a long time, it's a very different environment to just having interest rates continuously coming down. And we think, as I say, changing the team, getting a lot more quants and data science experience, we think is going to be important because the environment we're going into for the next 10 years, let's say, is going to be quite different potentially to the last 40 years. I think it's important to remember.
So out of curiosity, so you say the teams, I mean, give us an example of someone you've brought on board and the skill set that they bring, which differentiates you to kind of your traditional balanced team, which you were in the past.
Sure. So we look at ourselves, the 4 of us that were there before, more traditional asset managers, used to the traditional asset classes. Interestingly, I'm the only chartered accountant in the team now. We've got various degrees in the team. We've got 5 CFAs as well, so a lot of investment experience. But I give an example, David McNay, who we've hired from the UK, he joined us last May. Unfortunately, hasn't been to South Africa since he joined the team. He came for his interview in 2019, and actually because of COVID, he's still trying to get into the country. He should be vaccinated soon, which is good, so we'll see him hopefully soon in the country. He actually did astrophysics before he did his CFA, so rocket science. And it's interesting when I speak to him, I had the same experience when I worked at the bank in corporate finance. The most enjoyable people I like to work with were the engineers and lawyers, not the accountants like me, purely because people thought differently. And it's amazing when I speak to David, it's like he's been in our team for years now, even though he's been there less than a year. And I find his perspective completely different. We're having debates, and those of us who are used to experience in traditional asset classes, he just brings something completely different because of his different background, different working background, different educational background. And that's what we think is going to be critical going forward, that diversity of perspective. The kind of debates that we have now versus what we had 2 years ago are completely different, much more beneficial to the whole team. We think much more beneficial to our clients because you've got these different perspectives coming in, not just kind of bland discussions.
Can you give us an example of a debate?
Let's think. I suppose this debate, what's going on now about inflation, will it come back or not?
Yeah.
A lot of us think traditionally, we're just looking at the markers of money supply now. Money supply up, inflation's coming through, no doubt, because that's what history tells us, or that's what the textbook tells us. And guys like David in our team are saying, hang on, guys, we've got to think about the human perspective, interestingly enough, from that. What has COVID done to people? So we all know coming out of this crisis, because people have been locked up at home, you hear about this term revenge spending. People want to go on these amazing holidays that they haven't done for 20 years, and they're going to spend money on travel and that. Yes, that will happen in the first few months once they're vaccinated and governments open up. But what's going to happen post that? That's our bigger question. Structurally, what's going to happen? Guys like David will bring the perspective. It's more psychology debate. What's going to happen to the psychology of people? And the example he brought in for us was Japan. If you think about what happened after Japan's bubble in the 80s, peaked in 1989, that stock market, even though it's been in a bull run recently, hasn't got above that 1989 high now, more than 30 years later. And a big reason for that is the psychology changed. After their bubble burst, their government didn't do what the US government's doing now. They took interest rates down to zero, but the fiscal policy didn't push money directly into people's pockets like the US government's doing at the moment. And that's a debate for us. What the US government's doing now, giving money directly to people, does that keep the psychology up that inflation will always be there and keep going? The issue in Japan is psychology changed. They didn't give them money, everything collapsed, and the psychology changed from believing in disinflation and deflation. And deflation has been stuck with Japan now for the last 30 odd years because of that. And that was an interesting perspective. We didn't think about it that way. What is the psychological impact of inflation going to be? Not just what the textbook tells us and what we've seen historically. We always look at history to try to teach us the example, and we didn't think about that psychological aspect in Japan potentially. So as I say, important to have the different perspectives for us.
That's something asset managers always said, that you need that divergent view and the debate to get really good results.
Yeah.
And that's what you're saying. You kind of, that's how what you brought into the team, with guys like David.
Yeah. And I think importantly, the diversity of their background and educational experience. Guys will say it's people who've worked at different companies, but they're all in the same industry.
Yes.
All have done finance. We think it's important to have different backgrounds from that perspective.
And in SA, a lot of the time you get engineers coming to asset management business.
Yeah.
I suppose also off the back of kind of the mining kind of industry and things like that.
So more because they specialize in a certain industry rather than the diversity of thoughts. As I say, diversity of thought is going to be critical going forward. Remember, not a lot of people in this industry have existed, really worked through the 70s. There's a few of them, the really grey hairs, I've only got a few of those. But I think, you know, we haven't had people live through a period of rising inflation, if it comes. We still don't know if it does. Of rising interest rates, if they come, we still don't know if they are. It's very different to what any of us in our 20 to 30-year careers have existed in. Declining inflation, declining interest rates all the time. Very different environment we could be going into.
But also you think about the consumer, and the consumer, you go in, I don't know, I think about my mates, you know, we've all probably owned a house for 10, 15 years, and we've never had to worry about inflation and the impact on interest rates of our mortgage.
Exactly right. And South Africa is quite different to the likes of America. Remember, America's quite unique in that they've got fixed rate mortgages.
Yeah. And
everyone's been able to lock in these 30-year mortgages now at below 3%. They're going to be in a great position compared to the rest of the world. Most of the rest of the world has flexible interest rates like we do.
Yeah. And
for us, if interest rates have to go up a couple of percent, it has a big impact on our bottom line. As we saw now, where we are SARB cut interest rates by 3%, it had a big benefit to all of us because our mortgages all came down by 300 basis points, and that's important. You're right.
No, it's also pretty. I mean, like again, it's a warning to people that hang on, make sure you can actually afford to borrow money and in the future, and also cars. I think about cars.
Yeah. Same issue. Yeah. We always got told, you know, starting your first job and coming out of varsity, always stretch yourself. I'll never forget, my boss told me this when I was in articles at Ernst & Young. He said to me, whatever house you think you can afford, add on 50% because your earnings are going to go up and interest rates are going to keep coming down. He was right about the interest rates. Earnings was patchy, but that thought process, you're right, is potentially going to change. Depending on what happens with inflation, maybe actually wage increases might be a lot higher if inflation comes back, but you're going to be fighting at the same time interest rates going up aggressively potentially if that comes.
And we are generational spenders as well.
Yeah.
So we're generational spenders. We go out to spend. That's why I kind of obviously at the moment the shopping malls and that are struggling a bit. Yeah. But as you say, there's a high chance that we kind of and go, how do we go? What can we do now? I need to do something. I'm going on a holiday. I'm going to buy a nice dress or something for my wife, hopefully. Things like that.
And just on that, so as I mentioned, the issue of, I mentioned the term scarring, and that's the difficulty. We're doing a lot of work on that at the moment. Hard to tell because it's so unique. Unlike Japan, where the scarring was more the bursting of a bubble of both housing and the stock market. This is a COVID scarring. So what does it do to people? We haven't seen a health crisis like this also in over 100 years since the Spanish flu. And even the Spanish flu wasn't as global as COVID has been. Post the Spanish flu, interestingly enough, people say you saw the roaring 20s. There are various other reasons for that. It was also post the First World War. There was a lot of stimulus going in, which ultimately caused the Great Depression. But there was some scoring in different countries for different reasons. And that's a question we ask ourselves. As I said to you, after the bump in spending just coming out of lockdowns, what happens to sustainability to spending after that? Do savings rates go up? We've seen a big tick up in savings rates through COVID, more because people couldn't spend the money and there's been a lot of stimulus. But for the world economy to keep growing post this rebound this year, which is just off a low base, is you're going to need to see those savings rates come down. And that's our ultimate question is, do the savings rates stay sticky and high because people are worried about future employment? The other thing, remember, COVID has done is advanced technology. So we all hear this term AI, artificial intelligence, taking our jobs. And that should be a concern for many industries. But the bigger concern from us from a macroeconomic perspective is what does it do to the job market? So if it makes unemployment much higher than historically, will that mean savings rates will have to be higher? Because people are worried about, am I going to have a job in 6 months, 12 months, 3 years? You can see in the US, the labor participation rate has fallen dramatically from the mid-60s to 61%. Does that continue to happen? If that does, it's going to be a bigger strain on governments to provide more stimulus. And that savings rate means it doesn't go back into the economy and puts a cap on growth rates because it just doesn't come back into consumer spending. So all these things are going to play a big role. I think people are underestimating potentially. They see vaccines coming along, vaccinating people, and we're just back to where we were pre-COVID. There's a lot of things you've got to consider about how people's behavior is going to change, how government's behavior is going to change, what's going to happen to inflation and interest rates. It's going to make the world potentially very different to what we saw pre-COVID.
I mean, so one thing again, so we do kind of, you say you talk about kind of pre-COVID, COVID. So we spoke about March. I mean, March was a wake up call in many ways. I do think about the kind of the rah about lockdown and how that attitude has changed, because we now understand the reality of a lockdown. So I mean, but now we're at a point kind of where kind of the SA market and the global economies, they're kind of in recovery. I mean, you do very much feel that they are in recovery. Yes. Okay, and then and why are they in recovery, and kind of and where to from here?
So I think the easiest way to judge the recovery is to compare where GDP levels are to pre-COVID. Yes, the mix has changed. A lot more money being spent on goods when people are at home rather than services, entertainment and travel and that. But from the overall level of spending, for example, in the US, the consumer spending is already above where it was pre-COVID. Major reason for that is the stimulus, but the point is you can get there quite quickly with the right policies in place. Other countries are quite at different stages of that recovery. So when we say it's recovery in the US, looks like its GDP will go above pre-COVID by the third quarter this year. Europe probably only in a year's time will go back to where it was pre-COVID. And then the other markets are a bit different. China, we know, is already back above where it was pre-COVID, but they went into it earlier. Yeah. And then emerging markets like South Africa, quite far behind the curve from an overall GDP perspective, purely because we don't have the same ammunition that reserve currencies like the US and Europe have. They can throw a lot more money at the problem because they know people can fund it. When you're a reserve currency, there'll always be an attraction to buy their bonds and fund that recovery. South Africa, much harder. You know, our yields have gone up. We've got to make our yields a lot more attractive to foreigners to bring their money here and fund our recovery. Our government's trying to do what they can with the limited budgets that we have, but clearly our GDP, you know, we fell last year 6 to 7% in GDP. This year, we're probably only going to grow 3 to 3.5%. So from a level perspective, South Africa is unlikely to get back to pre-COVID levels within the next 2 or even 3 years. Probably later 2024, we'll only get there. So quite a long journey for us, but clearly the low has been put in, we think, this year in most economies, and it's kind of recovery from here. The other surprising thing, I guess, is that economies didn't fall as much as we were expected. If I told you going into last year, before the lockdowns, the world economy was going to completely lock down, would you have said to me the global economy is only going to be down 4 to 5% overall? You would have said I'm mad. You would have thought it's going to crash 20%. Yeah. And while it did, it was only, remember, on a 1 quarter basis. It started to recover quite quickly after that. So I think there's definitely signs of strong recovery. The bigger question is, where does GDP level off at? And what are governments going to do? The stimulus they've put in has obviously helped us to get back to these GDP levels where we are now, and we'll go back to pre-COVID levels, as I say, over the next year or two in most countries. What do they do after that? Does the economy start becoming self-sustaining like it was pre-COVID? That's the big unknown at the moment.
And what about like a third wave? So we all talk about this third wave. We know that vaccinations are rolling out actually really well in the States and kind of UK, Europe, maybe not as much in some of Europe. But the numbers, we know SA, there's this big risk of third wave. We're worried about Easter, we're worried about winter. Yeah. Europe, the numbers are picking up. I mean, what impact is the third wave going to have on this recovery?
Yeah. It's a great question. the third wave, and you've started to see it actually in some European countries, debatable whether it's a second or third wave. But the point is, will these waves keep coming? Interestingly, I was just reading overnight in the US, what they're warning about now in the US, the vaccination process, as you say, is so good. What they're finding in the US, the problem is people are rushing out without masks and doing what they were doing pre-COVID. And the US health officials are having to come out and saying, guys, you can't do this. Understand what a vaccine does is it doesn't make you immune to the virus. Yeah. It just makes your symptoms much less and doesn't make you as sick. So it controls the hospital problem, and obviously there's a lot less deaths. I don't think people understand that fully. I think that pent-up frustration of being locked up, as I say, revenge spending is a great term, because it's like they're fighting against governments. You locked us down, we're going to go crazy now. And that's why people like to talk about the roaring 20s. Interesting that we're in the 20s now as well, even though it's 100 years later. But I think what the third wave or second wave or fourth wave, whatever it is, reminds us of is this is going to be with us for quite a while. And in South Africa, vaccinations for us don't look like this country will be vaccinated above 60-70% of the population, probably only by this time next year. So a whole nother year to go. We've got to get through winter. As you say, it's going to get colder now. It just reminds us you've got to be cautious. People have to keep wearing masks, have to social distance. That's not going away from us anytime soon. On the upside, funnily enough, if the third and fourth waves come in different countries, you could see more stimulus coming. And this was what we found out what happened last March. Although it looked, as I say, going into it, if I told you everything was going to be locked down, looked disastrous from a macro perspective, if you get enough stimulus, as we found out, it can make up for it. And the other thing stimulus does, as we now know with hindsight, is that a lot of it flows into the equity markets and into all risk assets, actually. We've seen various other things like non-fungible tokens pop up, and cryptocurrencies are doing exceptionally well now as well. So you've seen a lot of other things, and this is a function of lots of money coming into the market. So I think if waves keep coming, governments are going to have to keep the stimulus pipes open, and that could be good for risk assets, funnily enough.
But again, doesn't it then create like a dichotomy between developed markets and emerging markets? Yes. Because again, you say like, we know we cannot afford just keep stimulus coming. We don't have the money. We have to go and borrow money from the IMF.
I think that's fair. Yeah. I mean, we always used to think there were all those books written by Reinhardt and Rolgo. If you get above 100% debt to GDP, your growth's going to fall off a cliff. And while recent history has even shown us that if that debt gets too high, growth rates do fall, stimulus makes up for the difference. But of course, stimulus is what's making the debt go higher and higher, and making interest rates have to be kept lower and lower to sustain all that debt. But you're right, the difference in the short term is developed markets can print a lot more money, can let their debt to GDP numbers go up purely because there are reserve currencies and money will continue to flow there. Emerging markets, where South Africa now, our debt to GDP is forecast to go close to 90%. Bear in mind, at the 2010 World Cup, we were at 30% debt to GDP. So we're in a vastly different place. At 30% debt to GDP, we've got huge scope to add a lot of stimulus to the system, add a lot of debt to the system. At close to 90% in the next few years, we're very limited in what we can do, especially given where our interest rates are, interest costs are so high, we can't keep adding debt to the system. So you're right, there will be a big dichotomy between the stimulus that can be added in developed markets and emerging, and therefore potentially an impact on what our asset markets do relative to offshore. There's no doubt about that.
We've got a couple of questions coming through. I think it's a very good time to get to them. So the first one is talk about managing risk. So back to, I think, our original question. And I'll read the question out. You alluded to managing risk earlier. How do you manage currency risk? What strategies do you use?
So we use what we call currency overlay risks, but it's essentially derivatives, either puts or calls or futures. And as I say, we manage it quite holistically. So we look at the risk of the currency, as I mentioned, across the portfolio, across the asset classes. And importantly, in our research, where do we think those currencies are going and what are we trying to protect against? In most asset classes, wherever you are in the cycle, all you're trying to determine is where's the asymmetric skew in that currency. And what I mean by that is where you're sitting, are the risks both the same up and down? So with the Rand now currently around 15, where do we think the risk is? Given our fiscal outlook, is the risk that the Rand's going to go to 12, or is the Rand going to go back to 18, 19, where it was in March last year? And we think, given our fiscal outlook, if the global economy doesn't recover post this year, doesn't continue to recover, and liquidity doesn't stay high and money flowing into emerging markets, clearly the risk to the Rand is on the weakening side. Where it can strengthen in a bull market to back towards the 14 level, we think at around the 14 level, it doesn't have much more upside from there, and the risk is for further weakness. So we try and position our portfolios to take advantage of that, participate in the upside if the currency weakens, and protect if the currency strengthens too much. But you don't need too much protection, because we don't think it's going to go much stronger than 14 in the bull market. What that means is you can put a structure in place that protects you between 15 and 14. And the way you pay for that is you don't get protection below the 14. And we think that's quite a smart way. It's ideas like that, knowing where the currencies in all probabilistic terms is going to go, and structure your currency overlays around those probabilities.
But also importantly, like, I mean, so a guy on the street or even myself, for me, I can't necessarily do that. So so it goes back to the expertise in terms of and kind of the skills and the resources you've got available as a fund manager to manage that risk. Am I right?
And we tap into large global banks, as you know, the Citigroups, Goldman Sachs of the world, that have teams that structure these products. And you know, us being a very large asset manager can get a decent cost of those products. A man in the street could try to go down this route of doing it, hellishly expensive for them on an individual basis. Even if you've got a decent size of wealth, the banks are going to charge you a hell of a lot of money versus an asset manager like us doing it across our suite of portfolios, managing multi-billion rand portfolios. It's going to be quite different for us.
Now, something we spoke about earlier, also before we came on air, was actually about active management. So often there's this debate, active versus passive. And you've got a very strong view that actually active management become a lot more important kind of going forward because of these types of examples.
And funnily enough, it's not just that active management is potentially more important than historically, as I say, because of what we think we may be going into, different types of cycles and what we've seen historically, shorter, sharper cycles up and down, is that passive will have its role to play. And what I mean by that is when we go into markets where we don't think active managers will do well from, say, a stock picking perspective or a fixed income instrument picking perspective, playing on the duration curve, where we just think being in the all-be at the right time would be more important than being the long end of the curve or the short end of the curve, that's when you use passive strategies. And passive strategies reduce our costs, which clearly we pass on to our clients. And that's an important distinction to make. It's not just about, we think active asset allocation will be much more critical going forward than it has been historically. So asset allocation, changing it quite often, using derivative overlays to protect different risks, as I mentioned, factor risks and style risks. But importantly, using passive at the right time. There'll be times when passive is going to beat active by a large proportion. That's usually what you saw last March, when a lot of money is flooding into the market. You just want beta exposure. Active management is not going to help you a lot from a stock picking perspective. It'll help you from an asset allocation perspective. At other times, when markets potentially go sideways, where you have exactly what we've seen actually in the past month or so, where the overall indices you look like they've gone reasonably sideways. The churning underneath that index has been massive, where you've seen growth stocks fall 20 to 30%. You've seen value stocks go up 20 to 30%. That's the type of thing we're talking about. In the environment of the last 4 to 6 weeks, active management on a stock picking perspective has been very important. Passive hasn't done well at all relative to that because it's gone sideways. But if you were in the right strategies and the underlying indices, you've done exceptionally well over that period. And that's the kind of environment we think getting that balance between active and passive, and importantly, the timing of switching between those two or blending the two of them is going to be much more important. In the term multi-strategy, that's kind of what we're implying. Multi-strategy, different strategies over time, the right strategies depending on what our outlook is, and importantly, how the market's looking. I'll give you one other example. With interest rates potentially rising in future, what you see is correlations changing. So what I mean by that, in the last 20 years, you've been awarded for holding equities and bonds. And the reason you've been awarded for that is they tend to be counter-cyclical. When equities do well, bonds have done badly. When equities have crashed, bonds have tended to do well. And that environment is potentially changing. We saw the start of it in last March. Actually, they both did badly initially together before bonds did well first, and then equities did well after. What you see historically is when interest rates and inflation start rising, those correlations tend to change. Interestingly, before 2000, so this is before the last 20 years, you actually saw a much closer correlation that they tended to move up and down together. When equities did well, bonds did well, and vice versa. You haven't seen that for the last 20 years. And because of that, people look back at the 20 years and think it's always going to be like that. Bonds and equities will protect each other. I can sit in the 60-40 portfolio and it'll be fine. We don't think that's potentially the case. If inflation and interest rates increase in future, those correlations can change back to what they were pre-2000. And again, you've got to think about asset allocation and protection of capital returns quite differently to what we have for the past 20 years.
Yeah. I want to carry on, get into more of the questions. So we can go off on a tangent and yeah. But I do want to pull kind of the audience listeners into it. Okay, cool. So here's a question: is it worth holding onto SA bonds?
Great question.
Yeah.
We have this debate almost daily now. There's the dichotomy between valuation of SA bonds and the fiscal position of South Africa. Valuation is only one of the 6 lenses we look at asset classes in, and I won't go through the other 5 in the interest of time. But at a high level, South African bonds are very attractive from a yield perspective. Be that on nominal terms, if you think about at the 10-year level, we're at about 9.5% yield.
Yeah.
And as you go further out, even from 13, 14 years, you're starting to get above 11%. So 11% yield in a country where inflation now is below 3%, and we know long-term we're targeting around 4.5%, but if they can keep inflation even below 6% and you're getting a yield of 11 above, it's a great return. In real terms,
Yeah.
you know, you're getting 5-6% easily. The question you've got to ask yourself is why has it got to over 11% now at the long end? And the reason it's got to over 11%, where historically it was below 10, is the fiscal position in South Africa. You know, where, as I say, the debt to GDP is forecast to go close to 90% in the next few years. And the bigger question is the SARB now and the government forecast that to roll over. Now, the problem we've got with that is potential growth as given by our government. They say it's around 1%, actually given by our Reserve Bank. They think it's around 1%. Potential growth tends to be reliant on population growth and productivity growth and what the capacity of your economy is. So the fact that they only think it's 1% when our population growth has been around 1.5% for the last 5 to 10 years per year tells you the desperate situation we're in. And that's a problem for us. I mean, the last 5 years, we've been growing on average less than 1%. So looking forward from here, if that continues to be the case and our potential growth is really only 1%, even though we're going to have a bounce back, as I say, probably over 3% this year, but then it starts normalizing from next year, is that fiscal position of the government is going to be harder and harder to keep a cap on. Will they be able to cap it out at 90, around 90%? And if they can't, how much yield are you going to have to give, especially foreign investors, to invest in our bonds? And our problem is 11% going to be enough? The reason why South African bonds are so attractive now is not just because that yield is so high for local investors, global investors, it's hugely attractive. Yeah. Think about developed markets. Their bond yields, some of them are still negative. Germany, Japan, Switzerland, they've still got negative yields, and we're giving you 9 to 11.5%. Highly attractive. Even if you're worried about the rand, you can take the risk and say, okay, the rand might depreciate 4 to 5%, but I'm getting over 11%, I'm compensated for that. And that's a debate, the further time goes on, if we don't fix these structural growth problems, we worry that over 11% won't be enough to attract foreigners, and the bond yield will keep weakening. Weakening, I mean, it'll keep rising. Yeah. And that means while your return now looks like it can be 9 to 11%, obviously if bond yields go higher, those returns come down. Your total return will be lower single digit, and that's a concern. So I know I'm avoiding answering the question directly, but you do have to weigh that up. Depends what you believe in, what the South African government can do in the next 5 years. Can they fix the labor policy? Can they change the structural growth problem from being too low growth? Those sorts of things, for us, we've got quite a big position in SA government bonds because the yield is so attractive now. And in our mind, it's paying you enough now for the protection against the cash yields in South Africa have gone closer to 4% now. So you've got quite a big buffer between the 11% and the 4% to protect you that if yields rise, they can rise over 1% and you're still going to get better than cash. And that's the kind of way up that we've got in our mind. So in the shorter term, we think you can own SA bonds comfortably. Once you start going past the 2-3 year horizon, starts becoming a much tougher question. What is our government going to do to control this fiscal damage that's been put in place? The debt to GDP, going too high. They've got to start controlling that in the next 2 to 3 years and have solid plans in place, which started to come out with this latest budget. And hopefully there's more continuation of that going forward.
So what's your current positioning in SA bonds at the moment in the portfolio?
Around about 25%.
Okay.
We've been a lot higher than that in history. Yeah. We've been up to half the portfolio in SA government bonds. But 25%, I would say, is about average for us over the last few years, more or less.
Neutral.
Almost neutral-ish on SA bonds. Correct.
So hopefully that then I mean, that answers the question. I know, yeah, it's.
I think it does.
Yeah,
Neutral stance, more or less, I would say.
Okay, cool. Another question, and it's another good question. You did touch on this earlier. Is global inflation a concern for you? And it clearly,
and the reason it's a concern is more because will it make the Fed act? As I say, the big difference now is the US Fed and all central banks around the world. Interestingly, for example, Brazil, Russia, and Turkey increased interest rates in the last 10 days. So emerging markets, some of them, and it's mainly because their currencies are under such stress, have started to increase rates. Developed markets are a much trickier thing. They don't want to increase rates, as they keep saying at all their policy meetings and their commentary to the investment community. We don't want to increase rates, again, because as I said, they don't know how this is going to pan out post-COVID. So they don't want to stop the recovery that we're seeing already. The reason why inflation is such a big concern is because, as all central banks will tell you, one of their key roles is to keep inflation under control. Yeah. So just to touch on that briefly, the US Fed, remember, changed their way they approach inflation for the first time in their existence over 100 years to be average inflation targeting a couple of months ago. And the reason why they did that is because they said historically, if you think about since the GFC, they haven't been able to get inflation back to their target of 2%. Core PCE stayed at about 1 to 1.5% on average, way below their 2% target. So what they've said now is, looking forward, we wanted to go above the 2% so that on average over a cycle, it's closer to 2%. And that's a huge change from them. So as opposed to the market historically looked at them and said, as soon as we see any inkling of inflation, we think the Fed's going to panic and raise rates, which often they did do preemptively. Now the market looks at them and says, we're seeing any inflation, the Fed's telling us they're not going to act. And that's a key decision. So while inflation's a concern, because of all the problems we've seen with supply chains through COVID, inflation in certain pockets like commodity prices you've seen ramp up aggressively, agricultural prices are coming through aggressively now as well. Inflation is certainly a concern. But as I say, the reason it's a concern is because what does it change in the reaction function, especially of the US Fed? At the moment, they seem in control. The question is the bond market going to take it away from them? And what I mean by that is the bond market, the US 10-year rate is now, I just looked this morning, is at 175. People were expecting it only to get to these sorts of levels in a year or 2 years' time, once the recovery had got a lot more pace. The bond market's already moving way ahead of the Fed. Historically, for the last 10 years since the GFC, the bond market was way behind the Fed. And that's a big change you've seen. And we think the change has become because of inflation, average inflation targeting.
It's almost like the Fed almost can't control the bond
yes.
Yeah, and that's the risk.
And that's the risk. And people use this term yield curve control. All yield curve control means is that they won't let it go much further than 175 2. We think 2% is the big marker in the ground. If the bond market gets there over the next few weeks or months, we think the Fed's got to step in. And the reason they've got to step in, the cost of debt becomes too expensive once it gets above 2%. And the sign it sends to the world is the central banks are losing control of this. Yeah. And the Fed has the money printer. They can print the money and control the bond market. While the bond market might riot, people might sell their bonds aggressively. Again, the Fed's just got to buy more. And we don't think the Fed has done all this hard work over the last 10 years since the GFC, all this quantitative easing, all this talk about how we're going to control the market, keep cost of capital low, and then just let the bond market take it away from them. So that's the big dichotomy at the moment. What will the Fed do if inflation does come back?
Sure. That's it's fascinating. Again, it talks to kind of this different world, investing world we're starting to live in. It's almost like a central theme that we're talking about today, and the importance of asset allocation. Another question, I mean, so I had it on my list because it always comes up, is what is your view on property, global and local? So
favorite topic of everyone.
Yeah, exactly. So I always put it down because I know it's going to come up.
Okay, so from a high level, I would say, like equities in general, global property has more diversification than local property. So let's just put that on the table. The nice thing about what would happen to local property in recent years, the same as the overall JSE, become a lot more multinational. So the local property market, only around half now exposure to South Africa. The other half between the UK, Australia, smaller, and Central and Eastern Europe, about a quarter of that. So nice geographic diversification, better than we had before. The problem we got is still over 20% is exposed to the office from an overall perspective, and probably closer to half now still retail exposure. Yeah. And as we all know, coming out of COVID, the outlook for those two sectors, retail and office, is still highly uncertain. Office market, you only have to drive around wherever you are. We in Joburg to see the signs out here, what they're offering, a year or two's rent free.
Yeah, I mean, just for so today we clearly we're not actually at STANLIB. So STANLIB is actually still closed. So we're all working from home. But Warren and I decided that actually be much nicer to have a face-to-face than a Zoom. And we're actually in Sandton. And driving into Sandton, two things that stood out for me. One is exactly that you have your to let signs on these brand new office buildings, which is quite scary. And the second thing is actually there's a shopping centre up the road called Athol Square, which was pumping a couple of years ago. Yeah. And we spoke about it. Tasha's, a big spa. It's closed.
Yeah,
it's literally
closed.
Yeah, so that is just a scary sight.
Yeah. It's a scary sight and a sign of the times. I only thought that type of thing was focused on the office market, but clearly in the retail market as well. So to bring it back to the fundamentals and the question, we've nibbled a bit at property. We own about 2% of it at the moment, which is the first holding we've had in a long time. Yeah. We were out of it in 2018. Thankfully, missed a lot of the correction. We thought it was overpriced, 2016, 17, 18. We thought it was getting way too expensive and exited. But the important thing is to bring it back to what is priced in the market. So you've seen a massive correction in the property market. You saw a massive correction pre-COVID, and then in COVID, you obviously saw a bigger correction. And while it's recovered a little bit, it certainly hasn't recovered like other sectors did from the March lows of last year. And that's the interesting part why we started nibbling. Valuations are looking interesting. So price to books have come down dramatically. Discounts, especially in the South African companies, of close to 40%. Some of them were even 50%. So we think that's pricing in a lot of the bad news, hence why we started buying it. The question you've got from now, still a high uncertainty, and why we're not overly bullish on it domestically or internationally. And as I say, internationally, it's got a lot more exposure to other sectors, not just office and retail. Yeah. That's why it's a bit more attractive. Internationally, we think there's better opportunities elsewhere at the moment. That might not always be the case, but we do think there's better opportunities. But to bring it back to South African local property, some of it's priced in. The outlook from here is highly uncertain. That's the thing we want to get across. There's some book value write-downs being taken by companies, obviously in the last year, in fact, over the last 2 or 3 years. We think those potentially aren't enough. And the reason we say they aren't enough, because we don't know where the markets are going. Yeah. We don't know where the retail markets, how quickly it's going to recover. We don't know how quickly the office market's going to recover. Therefore, there could still be further write-downs. So you're thinking, when you're looking at price to a book value, is that book value real? That denominator might still have to come down. So maybe there's a reason for the discount. And that's why we say the debate we're always having with property is it a value trap? And the reason it would be a value trap is because that valuation is telling you something. It's telling you the uncertainty is there. For us, the reason we started buying some, we're saying that valuation is pricing in a lot of the uncertainty, but potentially not all of it. If we thought it was pricing in all of it, we would own 5, 6, 7% of property. We're not quite there yet. And once we get more confidence on the outlook and how quickly those segments are going to recover, therefore more comfort in that valuation, we'll start putting more capital to work against it. Global property, as I say, looks quite attractive at the moment. 3 to 5% dividend yield with some growth, not as bad as write-downs as local. So we think potentially more write-downs to come, but much more diversified globally. As I say, for us, just relative to other opportunities, we don't think it's as good at the moment.
Okay, cool. Question from Julian. How real is the possibility of a sovereign debt crisis the next 3 to 5 years? And in this regard, what is the level of risk for investors in SA bonds?
Yeah, I think it's a great question to add to the earlier one. I don't want to be alarmist and say the risk is off the charts. I don't think it's quite that, because I think there are things we can do. The question is our ruling party, the ANC, going to be able to do that? And the reason I say that is, let's take an example, the labor unions. One of the biggest impediments to ease of doing business in the world, and South Africa ranks kind of in the middle ranks of ease of doing business. We used to be much better ranked 10 years ago. And as you know, President Ramaphosa has got plans to get us back into the top quartile of those rankings. But one of the biggest impediments to doing business in a country is your labor policies. And I saw this living in the States. It was the most astounding thing I've ever seen. People have this perception, I don't know why, that Americans are lazy. Well, I can tell you something. When I worked there, I've never seen people work harder. Nobody takes more than 10 days leave a year. And if you take more than 5 days, you're seen as lazy. That's literally how they work. And the reason it's like that is because
this is in Florida, which is
seen as a sleepy town of retirees. Yeah. I could not believe how hard people worked. And these are Americans. And the reason why is because the labor policy is so flexible. If you do a bad job and your boss doesn't like you, he walks in and says, Warren, unfortunately, I don't like what you've done in the last month. You've been here 10 years, too bad, goodbye. That's how flexible the labor. And I have zero rights as an employee, literally zero. I take my bags and my medical aid ends that day. I saw my boss do it there, unfortunately. He said to the guy, I'll give you 2 months pay and 2 months medical aid. And I thought, geez, that's not very much. And when he left, my boss said to me, do you know how generous that is? Nobody gives that. People, if they fire someone, their medical aid ends that day. That's how aggressive the labor policy is. So it's an extreme example, but I think that's why America is so dynamic and always bounces back much faster, because of their flexible labor policy. It's one of the core reasons why they're so innovative and so competitive. I saw that. People are hungry to work. They don't take leave because they're worried their job's not going to be there. Think about South Africa. We've got the opposite. We can't even hire people on a temp basis. And then if it doesn't work out, we give them 3 months or 6 months. We say, thanks for the work, thanks for the effort. It just hasn't worked out. You can't even do that here. That's the labor policy I'm talking about. Is the ANC, given how strong the unions are in the in the political debate and how important they are to the voting of the ANC back into power or keeping power, can they change those sorts of policies? So that's why I say there's the scope to do it, but are they able to do it? So the question, is there a fiscal crisis on a 3 to 5 year basis? I think there is. We think there is as a team, as I mentioned to you, because we don't think you can cap the debt to GDP at 90%. When you've got over 18 million social grants now, which is essentially unemployment benefits. When you've got 7 million people unemployed, when you've got the top 200,000 taxpayers paying 90% of the tax and aging, the average age of that is above 50, a lot of immigration, a lot of the big taxpayers leaving the country of all races. This is not just a white issue. Those are problems that you've got to arrest in the next few years. Otherwise, that debt situation does run away from you. And bizarrely, we always thought you want the IMF to come. The reason you want the IMF to come with a bailout is because they'll help you get this. We don't think the ANC on their own will be able to do it because things like the labor unions are so strong. The only way you get to do it sometimes is a bailout, because the IMF comes and they take it away from the ANC.
With terms.
With terms.
Yeah, and that's the key. The key is actually the key.
And we don't want to get to that. Clearly, you don't want to go to the IMF for a bailout. But unfortunately, if we go along the path we're on with 1% growth maximum, and we don't change the fiscal position of capping out the debt, the only way you're going to cap out the debt is not by just reducing your expenses like they're trying to do now, thankfully, with the public wage bill, is you've got to get the revenue going up. You can't get more tax revenue if growth's at 1%. It's just not possible.
But is unemployment also kind of at risk now at the moment because of the lag effect of COVID coming into play? So we've been in COVID for a year, and it actually hasn't the full impact hasn't come through from a kind of job losses perspective, etc.
And from the change of what's structural and what's cyclical. If it was a normal recession, what generally happens is those companies that can retrench staff or temp staff do. But as soon as, exactly what happens in America as well, but as soon as the economy comes back, exactly what you're seeing now in America, once the entertainment and travel industry is opening, jobs flood back. And you're going to see some huge job gains in America in the very next few weeks and months. That's exactly what should happen. The question that we don't know, and it talks about the scarring as well from a company side, is what did they learn through this lockdown? What were they able to do with less staff? What technology were they able to bring in? And now they realize, sure, the technology costs me more money, but on a 5-year view, the technology is a lot cheaper than bringing the people back. With the potential the minimum wage going up, I'm actually going to use technology. And that's why we worry that labor participation rate in the States continues to fall. And it means unemployment benefits will have to be higher. South Africa is an extreme example because our unemployment rate is so high by global standards, but it's happening all over the world. Will that change structure? There'll just be a lot less labor, less jobs available. That's clearly a risk going forward.
Also, there's like in the last year of COVID, there's almost like a social need to keep people employed.
Exactly.
And then kind of once this thing starts, I won't say fading away, it's going to be here for a while, but once that goes, you kind of the guy go, okay, the shareholders go, come on, chaps, you can't make losses. You actually make profits, and then the real pressure comes into kind of to labor.
Exactly. And think of what just us doing this, as you say, the first time we've both been doing webinars online from our homes. Think of what that's done. We've all realized I don't have to travel around the world to conferences. I've been to brilliant conferences from my home in a few countries in the last 6 months. It's been great. I haven't had to travel. The time it's taken me away from client money, managing money. It's been absolutely brilliant. And now we all realize we can do it at home. Think of what that's going to do to the travel and industry, to the hotel industry, etc. It's a game changer for a lot of industries from here, no doubt, structurally.
Yeah. There's one, so we've got 5 minutes left. There's one thing we spoke about, I think it's very topical at the moment, is vaccines in SA. It came out, you brought it up briefly. I mean, so Cyril made an announcement yesterday that he's bedded down with 30 million vaccines from J&J. I mean, you said earlier to me, you've done a lot of work around this. I mean, what's your view on the kind of what's going to happen to vaccines?
We were extremely worried before yesterday's announcement. All the work, David McNay, who I mentioned, actually done a fortune of work around this. And what he did was he looked at all the manufacturing capacity in the world. He worked with a couple of universities in the UK, and they've got databases of this. So it was a great data source that he got. And we think that's another thing. You've got to find different data sources in the world. Looked at all the manufacturing capacities of the Johnson & Johnsons of the world, Pfizer, AstraZeneca, and simply looked at what countries had ordered, because that news was kind of out in the public domain. Australia, Canada, America, all the developed markets had said what they had ordered. Some of these countries are very smart. They had ordered 5 to 10 times what they needed. So I've got a population of 20 million. I order 100 million, 200 million, because I don't know which of the manufacturers are going to manufacture first, who's going to be approved, and what the efficacies are going to be. So a lot of these smart countries ordered from all the different manufacturers.
And you cancel my orders I don't need.
Correct.
Yeah.
There's no, and of course with the terms, I said, well, if you can't produce it, I'm going to go to Pfizer.
Yeah.
If Pfizer can't, I'll go to AstraZeneca. So what they did is they compared those manufacturing capacities for what they can do in the next year, which those companies are also giving out in the public domain, versus what countries had ordered. And it was clear to us that emerging markets, especially South Africa, were far behind the curve. We were way at the back of the queue, and if we joined the queue, we were only going to get vaccines in 2022 at the earliest. What's actually panned out now, it's starting to pan out, as you say. Israel started fast, the UK and the US, those are probably the 3 great examples of who's doing it correctly. But what you find is, and exactly what Biden said, once they've used, and they ordered America a lot more than they needed, once they've used what they need, the excess they're going to start distributing to countries in need like South Africa. The great thing about having a company like Aspen Pharmacare in South Africa, unbelievable manufacturing facilities in Port Elizabeth that they've built over the years, FDA approved, so they can produce these vaccines. Just, we should be extremely thankful for having this company here, because I think the fact that they're located here and are going to produce here, we were able to negotiate, as Ramaphosa said, an extra 30 million doses for us. I mean, they're producing 300 million, was all targeted to be exported, which was crazy.
They also said that there's a 200 million going into Africa as well, which is
unbelievable,
because Africa is just way behind the curve.
Unbelievable. That's brilliant news, because as we all know, you can't just vaccinate certain countries. You need to vaccinate everyone, or the world can't go to a more normalized base. So we need to band together and get this vaccine rolled out as fast as possible. So on South Africa, we think it looks like if we get these, and certainly they're going to start manufacturing soon, most of the vulnerable population can be vaccinated over the next 6 months. And then post-September, kind of in those 6 months, will be the remaining part of the population. You and I, who aren't critical from a health perspective, will have to wait our turn. But most of the population by this time next year, it looks like now, can hopefully be vaccinated. We were worried this isn't going to happen until the second half of next year, but we're hoping that with these sorts of announcements, that can come a few quarters forward. And
then once the kind of the global vaccination process has taken place, and everyone's kind of, most of the places that herd immunity, then things can kind of get back to normal.
Well, if we use the example of the Spanish flu, the virus just eventually, they say this in the reports that you read about, it just disappeared. And it obviously doesn't disappear. It dissipates enough over time that it doesn't become a global concern. It becomes like the normal flu season where you get a vaccine every season. And that's the hope. The difficulty with knowing with this, you've seen a couple of variants that seem to be faster transmitting, but not deadlier, which is a good sign. As long as they're not deadlier, we think you can go down a path to get herd immunity, and then maybe every year you just get a COVID vaccine like you do a flu vaccine.
Okay.
And then the world can go back to some normality.
But again,
when we're going to have no masks, that I don't know. But one day, hopefully, in the not too distant future, we'll have that.
Okay, cool. I think we've pretty much come to the end of our time. So I should close now. I mean, Warren, thank you very much. I think it's been really insightful. I'm sorry I didn't get to all the questions. I think if anyone in the listeners, the audience out there, if you got more questions, please feel free to reach out to any of the innate BDMs. who can put you in touch with the STANLIB Asset Management BDMs or reach out to the STANLIB Asset Management BDMs. I'm sure they can help. So yeah, as a thank you to Warren. Thank you to everyone who dialed in and listened. Really appreciate it. Yeah, so just to wrap up, our next webinar is on the 20th of April, and it's with Dodge & Cox. Dodge & Cox are based in San Francisco. So I think the webinar is slightly earlier because it's quite a big time difference. Brian Cameron is the speaker. And I mean, I think he's going to dial in at about 10 o'clock at night for us to meet him at 8:30 here. But otherwise, that's it. Thanks very much, everyone, and really appreciate it. Thanks, Warren.
Thank you.
Shot.
Thanks for
Cheers.